Warren Buffett's early arbitrage strategy began long before he became known as the world's most famous long-term investor, and it reveals how disciplined, low-risk opportunities shaped his thinking about capital allocation. In the 1950s and early 1960s, Buffett operated partnerships that focused heavily on what he called workouts, a form of arbitrage investing inspired by Benjamin Graham. These situations involved corporate actions such as mergers, liquidations, reorganizations, or tender offers, where the outcome was largely predetermined but not yet fully reflected in the stock price. Buffett was not speculating on market direction or company growth. Instead, he was exploiting pricing gaps created by uncertainty, paperwork delays, and investor impatience. A classic example was merger arbitrage. When a company announced it would be acquired at a fixed price, its stock typically traded slightly below the offer price to reflect the risk that the deal might fail. Buffett would analyze the probability of completion, the time required, and the downside risk if the deal collapsed. If the spread was attractive relative to the risk and duration, he would invest heavily. The return did not depend on economic growth or stock market sentiment, but on whether the specific corporate event concluded as expected. Another common workout involved liquidations. When companies decided to dissolve and sell their assets, the market often undervalued the remaining shares due to complexity and lack of interest. Buffett would carefully estimate the net value of cash and assets that shareholders would receive after liquidation costs. If the stock traded at a meaningful discount to this value, he would buy, often achieving strong returns once distributions were completed. One of Buffett's earliest and most famous arbitrage-style investments was Sanborn Map Company. Although not a merger, it functioned like a workout because the company's investment portfolio was worth far more than its operating business. Buffett accumulated shares, pushed for changes, and unlocked value through asset separation, demonstrating his ability to convert balance sheet mispricing into predictable gains. During this period, Buffett often ran portfolios with a large percentage allocated to workouts, sometimes exceeding 40% of invested capital. These positions produced steady, relatively low volatility returns that helped compound capital while reducing reliance on market movements. Importantly, Buffett treated arbitrage as an exercise in probability and discipline, not excitement. He wrote to his partners that the goal was not spectacular wins, but consistent, repeatable results with controlled risk. He also emphasized position sizing, often spreading capital across multiple independent workouts to avoid catastrophic loss if one failed. Over time, as Buffett's capital base grew, arbitrage became less practical. Large deals could not absorb the scale of money he was managing, and competition reduced spreads. By the late 1960s, he acknowledged that workouts were becoming less attractive and shifted his focus toward acquiring high-quality businesses with durable competitive advantages. However, the lessons from his early arbitrage years never disappeared. The emphasis on downside protection, rational probability assessment, and patience became core principles of his later investing philosophy. Warren Buffett's early arbitrage strategy was not about clever trading tricks, but about exploiting inefficiencies with discipline and realism. It laid the foundation for his understanding that investing is not about predicting markets, but about identifying situations where the odds are clearly in your favor and acting decisively when they appear.